Let me show you something that looks like magic the first time you really see it. This is Nasdaq, and on the left, we're looking at a 15-second setup. And on the right, you're looking at the same setup occurring on the 1 hour. Same behavior. And in a second, I'll also show you that this is part of a bigger model. In this video, I'm going to explain fractality in a way that actually changes how you see price action. We are going to start on the 1 hour and then we'll zoom in and I'll prove you that every retracement contains a complete market maker model. And then we'll zoom out and you'll see that the model you just traded in reality is just a retracement on a higher time frame where a bigger market maker model is playing out. But first, let's do a quick definition. What are market maker models, or MMXMs? They describe the repeating behavioral cycle through which IPDA moves price to engineer liquidity, accumulate or distribute positions, and deliver price efficiently towards a higher time frame objective. It's not about a single pattern, it's the logic of intent behind price action. Think of the market like gears. The bigger gear turns slower, but it has more power. That's your weekly, your monthly objective. And then we have the 1 hour, which is the gear translating that objective into a tradable move. And finally, we can see on the 1 minute or the 15-second that is the smaller gear, which can look fast, noisy, but it's the mechanism that actually prints our entries that we find every day. When you zoom in, you're not finding a different market. You are just looking at a smaller gear of the same machine. And that is where most traders get it wrong. They start from the 1 minute and then they beg the higher time frames to confirm what they think must happen. I do the opposite. I start from an intermediate time frame because it tells me the story that I'm actually trading. On the 1 hour, here is the market maker model that I identified. I'm not asking, does the 1 minute agree with me? All I'm trying to find from this time frame is what is he actually trying to do? So what is the order flow? Where price is actually drawing towards? Where does it want to do it from? So what's the point of interest where price needs to go to then expand? And only after that, how will the lower time frame express this expansion? So now, watch the retracement on the 1 hour. This pullback is where most people get chopped because they treat it like noise. But if you zoom in, this pullback is a complete market maker model. Here, on the 1 minute, the market does the exact same job. It engineers liquidity, it shifts order flow, and then delivers price. All of this happens just on a smaller scale. So the 1 minute setup isn't extra confirmation. It's actually the mechanism that the 1 hour model uses to complete its next leg. Every retracement is its own market maker model. But the market maker model you are trading on the 1 hour will look like a retracement on a higher time frame. This is really the part that I want you to internalize, that at any given point in the market, you can always zoom lower and find smaller market maker models. You can also zoom higher and realize that your model is only a piece of something bigger. Lower time frames are really the how, and the higher time frames are more of the why. Now, let's zoom out, because here's the missing piece. Why did the 1 hour model matter at all? This is what we see on a 4 hour. And I would say that this is what the weekly was trying to say. We have a bigger market maker model which is playing out. And look where that 1 hour model sits. The blue box is the 1 hour market maker model that I just outlined to you. What does it look like? It looks just like a retracement inside this fair value gap, this CB that was used prior as a resistance to push price lower, and now we are using it as support after we have broken above it to push price higher. And nested inside it, we can also see this order block, which aligns perfectly with the low of the week. So the 1 hour trade is actually just the weekly model expressing itself through a smaller fractal. And this is why the market can look chaotic on a small time frame, because you're watching a chapter without knowing the whole book. And this is something I tell my students all the time. Stop waiting for everything to be in line. Timeframes disagree constantly because they are telling you different chapters of the same book. One time frame is telling you we are in a pullback. Another time frame is telling you this pullback is part of the delivery, is part of the profile of whatever cycle you are looking at. Neither one of them is lying. They are describing the same structure at different levels. You have to know at any given time which chapter you are trading in and why. If you are a beginner trader, then of course trading in line with order flow is going to be so much easier. But with time, I'll show you examples of beautiful trades that happen against the order flow and how you can take those by reading in between the different time frame perspectives. So here is the framework that I really want you to use from today. Start with the why, then find the where, and only then you can zoom in the how. The why is what is the higher time frame trying to deliver? Where are we going? Are we going higher or are we going lower? Secondly, we have the where it wants to reach into before delivering the why. And then you can zoom in the how. What does the lower time frame do to express that intent? I know this lecture was rather vague. I'm just trying to put out some basis for the future lectures, but I'm sure that I have hidden loads of gems throughout the words that I just spoke. And with that, I want to wish you guys a very nice rest of your day, and I'll catch you guys in the next lecture. Be safe.